This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Francisco Vaca. This is Francisco's second appearance on my show. For those that will recall, Francisco once worked for C D Commodities out of Chicago, Richard Dennis's firm. Not a turtle, but worked for Richard Dennis after the turtle program. He has long had an association with Paul Rabar, one of the turtles. And for many, many years, Francisco ran his own trend following trading firm. Today, he is the co-chief investment officer at Rabar Market Research. Again, as I just mentioned, Paul Rabar's firm. Together, they run Rabar Market Research. Always insightful to have Francisco on my show. I hope you enjoy this conversation.
I am now the co-CIO of Rabar Market Research, which is a CTA run and founded by Paul Rabar. Paul Rabar being one of the original turtles, and I guess all your audience is well familiar with the turtle story. I have known Paul for over 15 years. For almost 15 years, we've been partners. He seeded Vaca Capital Management, my money management company, in 2000. And we have worked side by side, essentially pretty much at every aspect of trading throughout the years. In 2013, we decided to put the two companies together. You know, this is one of those rare instances where you get, two CTAs really, not only do they know what each other is doing, but having the ability of combining their two trading styles and trading programs. And starting at the beginning of 2014, June 1st, 2014 to be exact, we rolled out the enhanced version of the flagship Rabar Diversify program, which now incorporated the Vaca program from when I was running it, in combination with the Rabar program when Paul Rabar was running it, to put them together with the spirit of the best ideas concept. And we have been running that since January 1st of 2014. Now, I don't want to overstate that these two products were already shared a lot of common ground, and they had a lot of similarities, and they had a high degree of correlation. But nonetheless, there were things here and there that were different from one another, which we managed to put together into the new program.
I want to do a little bit of a historical footnote here and go back in time to meeting Paul. I would love for you to talk about that story and perhaps maybe sharing some of the early lessons across the different aspects of trading that you learned from him. Obviously, he had some great teachers, and you're both peers working together now. But early on, I'm sure you learned quite a bit from him.
Oh, there's no question. I had been fortunate enough to be working for Richard Dennis and Bill Eckert in the second half of the 90s. During that time, a lot of the turtles would walk into C&D being Richard Dennis's company, would walk into C&D to see Rich. So I had the opportunity to meet many of the turtles during my 5-year tenure there. When Richard Dennis called it quits at the end of 2000, I talked to many of the turtles and other CTAs. I ended up choosing Paul as my partner. I'm so glad I did it back then. To answer your question as to what have I learned from Paul, one of the things that I value the most is, his ability of looking at the trading, not only from the trading part of it, but also from the business part of it. I think it's very important to understand that in conjunction with trading, we do have a business to run. We do have clients to deal with. And it was very important to balance those two. And I also know that, Paul has spent, basically 30 years doing this. So watching him do it is also a very interesting thing to see. I think primarily knowing that longevity in this business is very important. And trading is conducive to blowing up, to making mistakes, to doing a lot of things. And avoiding mistakes is one of the things that I've learned the most from Paul over the years.
I don't think it's part of the conversation today, and it's more of a footnote, a historical note. But it's amazing that so many people, because obviously, as you mentioned about Rich Dennis, and he stopped trading at that point in time. And often there was you'd see some press and it was a little negative and this and that. But for some reason or another, it seems like maybe today that's changed, but the press never really seemed to notice or care too much that so many of his students, his former partner, Bill Eckhart, just kept on going. And I think there was a lot of press way back in the day that somehow or another, because Rich Dennis had decided to either stop or his strategy had not been going well at that particular moment in time, it got extrapolated. But then here as you just make the point, 30 years. I mean, that's a long time.
It is indeed, yes. It is a long time. I think that people overlook that. I know of a group, I should remain nameless, that it's fund of funds. For the longest time, they spent a great deal of time searching for new managers, new talent. And that is, an interesting approach to finding new ways of investing, by hiring new talent. And they neglected to weigh in the fact of longevity. So what has happened is over time, just to quote them, they end up kissing a lot of frogs, so to speak. There is, many managers that were undervalued by them because, the performance over 30 years, well, you can imagine having to conform to the evolution of the markets of, over 30 years. They were seduced by 2 or even 1 year track record that appeared to be fantastic. But, time has told them that it was a mistake, that, one should prefer things that have shown evidence of a really long track record. And I think now there is a big appreciation for that. And it's only now starting to show because, as you said, it's now in the decades. It's not the years. It's really decades of evidence.
Now, as you try to scare every up-and-coming trader out there from starting because you have a 30-year track record, it's interesting. I've had a couple young guys on my show recently, maybe like 4 or 5 year track records, late 20s, early 30s, the guys, mostly trend-following styles, trading very typical. And you could look at their month by month, you could look at their annual for their first 3-4 years, and you can see it matches what your expectations or what my expectations should be for how trend following has performed in this period. I mean, you can see they're doing what they should be doing, but nonetheless, it's still tough to compete against the 20-year and 30-year and 40-year track records that do exist out there.
Correct. There is another element to this nowadays, which is every strategy, when it starts, it becomes a viable way of investing. We call it alpha. Over the years, the word gets out the evidence begins to show in many different places, and then that strategy becomes into a beta because it's reproducible, because others who have not been trained can figure it out just by looking around the literature that has been published. So we got into a point that we're trend following, the classic trend following. And here I'm going to define classic trend following as long-term trend following. That nowadays, I think, can be reproducible. And you can have, younger folks, persons come in, but it's harder to make the case that they're bringing anything new to the table. The track records may be the same or a little better than someone established, but at the end of the day, without something different, without a different time frame or different technology, it's difficult to make the case. And not that I want to scare anybody from trying this. By all means, anybody who thinks you can do this owes it to himself to do it. But at the end of the day, they have to make sure that they are going for the alpha and not the beta of trend following.
Yeah, good words of wisdom. Good words of wisdom. Let's go ahead and break apart in the rest of our time today. I'd like to break apart some of the ideas, thoughts, concepts behind your current styles at Rabar today. And just a big picture point. I've seen that you've talked about, for example, the one of the programs, 109 markets, 7 sectors, 34 countries. Only exchange traded though. You're not yet at the point where you say, okay, I want to go off exchange. You want the highly liquid, exchange traded credibility, and that's where you're going to play ball. You don't have an interest in flying out on a ledge somewhere, and this isn't about taking flyers. You want to be in the highly liquid, trustable markets.
Correct. The way the program is designed is precisely to have a level of scalability. There's also, the program is designed in such a way that one can trade multiple time frames. We know now, we didn't know this, let's say 20 years ago, but we know now that time frames of meaning the average holding period that a trend following system holds the trade, it has a big impact on the not only the risk reward profile but also the return streams. And we basically trade across the entire time spectrum of holding periods, because we know, for example, if you were to look up, let's say, the New Edge Trend Index, which is comprised, I believe, top CTAs that are self-proclaimed trend following. These are the largest CTAs in the world. When you look at the returns of that index, you'll see that in 2009 it lost money, whereas we made money in 2009. And the reason we made money in 2009 is because we, even though the long-term systems lost money, the medium-term systems lost money, the short-term systems made money. In years like 2010, when, again, using the New Edge Index, Trend Index as a comparison, we made money. We made way more money than the index. And the reason is that in that year, the short-term systems performed better than the medium-term systems, which performed better than the long-term systems. Now, in a year like 2014, it was exactly the opposite. The long-term systems did better than the medium-term systems, which did better than the short-term systems. But the key point is that you want diversity. We know now that we want to be as diverse as possible. And not only do we trade 109 markets because they're liquid, but we trade them because they allows us to trade all the time frames. If we were to trade, let's say, products that were not listed or products that were not liquid, then we would not be able to trade the short term and possibly not even the medium term systems. Now, short-term systems I define as systems that on average hold a trade for about 8 days, and medium term for about 36 days, and long term about 100 days.
I'm curious, discretion. Obviously, there's discretion when you and Paul sit down and you start saying, okay, these are the types of systems that we've been working on. There's the human element at that point in time. Once the system is put in place and is running, is there discretion on top of that, or is this 100% systematic?
No, it's there is no discretion on top of it, but one cannot claim it's 100% systematic if we are willing and able to intervene. If we feel, let's just say, New York lost power, should we pull all of orders out of the market until we figure out what's going on? Things of this nature, we can always intervene because, the models, the systems don't know anything of external factors that could impact the risk reward or the risk we take at any time. There certainly isn't a consistent discretionary element to what we do, and maybe that's a better way of describing it.
It's more, if discretion is thought of, once the systems are up and running, discretion is more thought of as kind of catastrophic type events that are not necessarily related to the trading. But if markets are open and markets are liquid, you're not letting the invisible hand of individuals come in and really affect your systems. Your systems are running fine then. I think you make a good point, though, about the discretion, because I think every trader would probably say what you just said, that if something catastrophic happened, of course, at that moment in time, you would bring the human hand in and intervene.
Correct. And that's why we said, that's where the level of discretion comes in. But, we trade 225 systems at the moment and counting.
You're gonna have to break that apart for a second and just get the audience out there to understand how 200. I mean, look, everyone's got limited capital, so you're trading 225 systems. Explain that.
Well, here's the way it comes about. If you look at the way trend following and managed futures systematically, I'm talking about this is from our point of view. We have always wanted to trade more systems. This is something that forever in my career, this is something that we just had dreams of doing, but we were never able to do it because you would need a very, very large operation to have many systems being traded concurrently. In the old days, everything was done manually, meaning that if you were trading 5 systems and you would look at the order generation from each one of these systems, and you would have to follow the markets, and when the system fired a signal, you would pick up the phone and just, for example, say, buy 10 S&P contracts. And well, you can imagine how hard it would be to do that with humans if we had 200 or plus systems, which is what we have now. So the driver for that ability is technology. Now, I came from a research background in particle physics. I worked at Fermi Lab, which at the time was the top particle accelerator in the world, now overtaken by CERN, which I'm sure everybody in your audience is familiar with. And, back then, companies like IBM and Microsoft, Cisco, all these companies would come to the lab and give us the brand new technology that it was still experimental so that we can play with. So on my end, I've always had this appreciation for technology. We live in an era where everybody walks around with a smartphone, and it changes the way we do things. So trend following in that sense is not any different. It's trend following as a process, and you have to ask yourself, what technology is available today to better my process, to make it broader, stronger, quicker? What can I do? And over the years, we've created internally a complete suite of trading. All the code we use is 100% proprietary. We have built everything and rely on no one when it comes to software. What we have done is created the technology that has enabled us to trade literally a limitless number of systems. We have a co-located server at in one of the a center in Chicago, which is a hub or telecommunications hub in Chicago, and we have cross connects to 3 major brokers, and we can get in and out of the exchanges in under a millisecond. So we're not a high frequency trading shop, but we do apply high frequency trading techniques to the execution of an order. We can pull in or pull out of the market literally thousands of orders in a second.
I would think one of the interesting aspects here is that with so many different systems being traded with limited capital, I mean, everyone has limited capital, and the markets out there, the risk management aspect, how one allocates the capital, the limited capital to assorted markets when trading multiple systems, when surely there will be positions within those systems that are aligned and going the same direction. And I'm sure there'll be some times when the systems are going different directions in the same market. It can start to, I can see where you're going here. As you're saying, we're not a high frequency shop, but we're applying the high frequency mindset to trend following.
It's not so much that the high frequency comes at the execution level. The
technology level.
The technology. Essentially, if I know I need to execute 100 S&P contracts now, what is the best way of doing that? That's where the technology comes in terms of high frequency and execution. But the technology really affords us to track live a limitless number of markets and systems because it's all happening with computers. The computers have on one hand, they have a data feed. On the other hand, they have our systems, our order generation, and they are a network of brokers that are connecting to us. And all these brokers can go into all the same exchanges. So we have different routes. So we have redundancy, many different ways. Because we don't believe in backups, we believe in redundancy. And so this really allows us to trade many different trades a day. I mean, a lot. So, going back to your question about discretion, there really isn't, number one, no time, and there really isn't nothing to think about because these trades are now tiny relative to the portfolio. This is the same problem that everybody has. That is to say, if you go back to Markowitz in the 50s, how do you put together a basket of strategies? How do you go about electing? How do you go about trading all these systems? Whether it's, let's say you're a fund of funds and you're thinking of how am I going to put all these managers together? Ultimately, it's clear that everybody wants the more systems, the more investments, the better. That's very clear. But you may not be able to do it.
Could you make an argument that you're, with that many trading strategies, that you are a fund of funds?
Oh, without a question. I have actually told funds of funds in meetings that we have done the hard work for them. We have.
Do they like that?
Some do, but not all of them. The reality is that we have gone to the trouble to put together trend following systems that are short-term, medium-term, long-term, and even systems that we call trend anticipating, which are in some sense a spin-off of the trend following technique.
I had that as a note here to ask you about. Talk about the trend anticipating techniques. So that's if you're looking at the price data, you're looking at a chart, that there is no discernible no discernible trend in the logic. But are you discerning something in the price data at that moment in time, or is your decision making based on something else? Talk about the trend anticipating techniques.
Right. Well, when you think about trend following, particularly when you're thinking about it from a systematic point of view with the use of a computer, and when you have limited yourself by choice to only use price data, it boils down to having a series of indicators which are calculated based on some metric. Your experience would say, I want to buy if the market has a certain type of pattern. And we call that a trend because it has been going up, let's just say, for some time. And in trend anticipating says, essentially, it's the exact same technique. But let's not limit ourselves to what we believe should work. Let's think about what might work. Put it into the computer and ask the computer, well, does it work? And what we have found is that, yes, indeed, there are many times when you can come up with indicators that are completely driven from, the price data. And these indicators are, what they're trying to do is attempt to sniff out when a trend is about to start, with the idea that we will get early onto these moves rather than once the move is very clearly established and now we can add or start our position. These types of systems will get in many times when they're just simply, if you look at the chart, no trend following system would get in. It may be even, in a consolidation period and you just can't seem to figure out why. But the computer, because of statistics, the computer has the ability of trying many different things and noting whether the system yields profitable trades or not. And if it does, then, we have found what we wanted.
At 200 plus systems, clearly you are both entirely fascinated for reasons that you see beneficial, obviously producing profit, but you guys are just slicing time and trend in a multitude of ways, yeah?
Correct.
Yeah.
The idea is that the cost of trading have come down in terms of the transaction cost. Back in the 90s, we wouldn't be able to trade short-term systems, maybe in a handful of markets. And for that reason, people didn't trade them. Nowadays, we can trade short-term systems because the liquidity in these markets has gone up several-fold, allowing us to justify the in and out of a trade. When you think of a trade, for example, and you say, well, it cost X amount to initiate the trade. There's transaction cost. It cost X amount to get out of the trade. There's transaction cost. So a trade that lives 3 days better be really, really beefy in terms of expectations to make up those two costs, the in and the out. Systems that are, 5, 8 days are difficult to find, but they can be found. And they're only now available because the reduction in transaction cost over the past 20 years has been, fairly dramatic.
I'm thinking back to some historical years where the longer term trend following has done exceptionally well. You might have other days or years you want to add, but let's get to 2002, 2008, 2014. Are there situations when you're trading this many systems, slicing the trend up, slicing the time up, that when the big moves happen, the really big, wild, out of the blue moves that really push the longer term trend following performance, and as well, you often see the typical just holding equities performance really drop big. When you see those divergences in the returns for those two particular ideas, as you guys are going this many systems and slicing the time up and slicing the trend up, are there negatives for when those big years happen with the strategy that you're going now? Or even though some of those shorter term models and whatnot, do they still adapt well to go with the trend even when it's at a much shorter time frame? Do you see where I'm going with that question?
Yes. But I wouldn't think about it in terms of negatives or positives. It really comes down to what do you want out of the trading. Clearly, in a period where long-term trend following does well, you want to be all long-term trend following, right? But the thing is that what is better over the long run? Only long-term trend following or the basket of all available time frames. Now, the research show, the evidence show of 10 years of trading like this shows that shows that you want a basket of time frames. That part, I believe, is what you want. Now, there's going to be periods of under and over performance, but on balance, the risk reward will be better off by having a basket.
Well, and that gets to your point too. It's right as I asked that long question. It's and I finished. I'm saying myself, but hold on. What's the trader attempting to deliver to his clients? What's that trader attempting to pull from the market? What are you delivering? And I think your answer, what you're really saying is we're not necessarily trying to deliver only what you might imagine by looking at the historical data. We're attempting to deliver this. And as I made the point a few minutes ago about the fund of funds, clearly you're looking at ultimately the performance using all these different systems. You're looking at for where you fit in the spectrum of managers out there. I mean, specifically from a correlation perspective, I'm guessing.
Well, for us, it's about delivering the best return that we can. It's not about delivering a certain return profile. As though some managers may say, I want to be long-term trend following, and that's what I want to deliver to my clients. In our case, we want the best we can deliver. And we know that long-term trend following alone is inferior to a blend of timeframes and trend anticipating type systems. And so with that in mind, if you were going to put a selection of managers, you would go your fund of funds and you would go and say, I want a long-term trend follower. I want a short-term trend follower, and you start putting together your basket. We have done all that. And the reality is that, we hope over the long term, which it already has shown, that our performance sticks out in terms of the risk reward when it comes to evaluating. We're not too concerned about the correlations, as correlations are a bad indicator of how to assess the how similar two products are.
But it sure is an indicator that as we mentioned, the fund of funds again, it's an indicator the world of allocations sure uses a lot, don't they? Yes, and the correlations tend to be misrepresented. Correlations, if understood correctly, are a great tool, but I often feel that they are misinterpreted. And sometimes I give people a puzzle to see whether they understand correlations or not. If you wish, I can give it to you. Yeah, go for it.
Okay, so
educate us.
So if I take, let's say, my personal track record, and I were to take my track record, and based on this track record, I would create a fake track record. And the formula for creating the fake track record is by saying every time my track record, I should say every time, every month, because this is a monthly track record, every month the track record is positive, the fake track record will make only half as much. Every month that the track record loses money, the fake track record will lose twice as much. So there's a factor of 2. Again, when we make money, we only make half as much. When we lose money, we lose twice as much. So you basically have my track record and then this fake track record constructed as I just described. So the question to you is, what is the correlation between these 2 track records? First, let me tell you that my track record makes money and the other track record loses money. So you can imagine an equity curve going up, and the fake track record is an equity curve going down into the negative. So now with that in hand, I would ask you, what is the correlation between these 2 track records? And I'll give you multiple choices. Given that we use the factor of 2, is it plus 50%, negative 50%, 0, or 92%?
Am I being put on the spot?
Yes. That was the whole point.
They're positively correlated, aren't they?
Yes. Okay, so that gives you, it narrows down with 2 choices, 50% or 92.
Well, I'm not even attempting to guess at that one because the 92 is telling me that there's higher math involved. Or either that or you purposely fooled me.
All right, I'll give you the answer. It's 92%. So the question is, how is it that 2 track records, one that it's clearly making money, and I can show you an Excel sheet if you're more interested.
I knew as you were saying it, because you're basically describing a situation where there was a consistency happening. So you knew in your head, even without crunching the math, you knew in your head that the correlation was extremely high. And I think your ultimate point was, hey, great correlation. Look at the performance. Performance 1, good. Performance 2, terrible. So what's the point of the correlation?
Correct. And that is indeed what I'm trying to highlight. You know, you have a money-making scheme, a losing-making scheme that are 92% correlated.
Yeah.
And so this is just pure math, basic math. And the reason that this is like this is because when we look at the correlations, we look at the direction of the change. Notice that in these 2 track records, both track records are in identical direction each time. They both go up and they both go down. That's because by construction, it's the size of how much they go up and how much they go down that matters, which is completely overlooked by the correlation. And we know that equity curves are created geometrically by the compounding effect. So correlation completely ignores the compounding effect. It only tells you, what is the relationship with the ups and downs.
Well, it also brings to mind, it's a whole different subject. I think back to the Sharpe ratio versus the Sortino ratio, and you start to look at things like upside volatility and downside volatility. And you have an entire investing population out there that I gave a presentation recently, and this very, very nice lady, very well dressed, probably in her late 20s, early 30s, probably a much higher education than me. And at the end of the presentation that I was making about trend following, she raised her hand. She wanted to talk about Sharpe ratios. And you could see here's all this intelligence completely ignoring the fact that just because there might be some volatility on the upside doesn't mean it's a bad thing.
Oh, absolutely. In fact, they've demonized volatility. They come with these ideas of Sharpe ratios, Sortino ratios, and so on, which, make intuitive sense, but you have to understand them. And, I can give you, as you said, this is maybe a totally separate subject, but, there's all kinds of problems with the Sharpe ratio, and you can go to Wikipedia and look it up. And that's the reason we don't use it. One of the things that people have to create when they're evaluating a system, a manager, an investment, is a metric. So often, the easiest one to calculate is the Sharpe ratio. I have invented a long time something that I call the preference value, which is a different metric. And for lack of a better term, I guess I'll make it public on your show. I think of it as a geometric Sharpe ratio. And the only reason I use Sharpe is because it is looking at a ratio of two things. But it's certainly not the average return and certainly not the standard deviation. What I attempt to do is to take the entire knowledge that is inside the distribution of the returns. You can look at a distribution of the returns and say, okay, I'm going to describe the distribution of the returns with two variables, the average return and the standard deviations, and ignore
what happens in between.
Exactly. That's exactly right. What happens in between? And also, we live in the world in a geometric world, so to speak, when it comes to investments. Everything is geometric. It's an equity curve. So why am I ignoring the compounding effect of all these things? So I, worked out the math many years ago, and that's what we use as our metric for evaluating a system.
I was just reading the other day, I'm working on this project, and I've been reading a lot of information about CTAs and autocorrelation, and there's a really interesting piece that New Edge did in the last couple of years. But there's just so many ways that if one wants to judge those traders that use futures on global exchanges and uses quantitative methods and has an affinity for tails and doesn't just think that everything in this world is normally distributed, there's some really wrong ways that people look at volatility. There's some ways that traditional investments get benefits in the eyes of managers and allocators and the public that perhaps, not even perhaps, they give a sense of safety that shouldn't be there. And they also position, I think it's a fair statement to say, they position traders that trade in the quant methods, as we talk in the CTAs, trend following, position those as much more risky than they really are. When you really get to, and it's high level math. I mean, you're a high level math guy. It's high level math, but when you start to wrap your arms around what this high level math is telling you, and you start to kind of look at it in the real world, it's really interesting how these worlds of the traditional and the alternative world have been segmented, and the alternative world always has to fight for its place at the table. That's for sure. Oh,
there's no question. It's a way that things have been presented to the public, right? I mean, someone at some point, Sharpe came up with an interesting way, for something that was invented 40, 50 years ago. Okay, that's fine. But, I think we've evolved and made some progress over the last 50 years. So, but things sort of get stuck in the past. And as they go mainstream, people think about these things in a certain way. And it's very, very hard to make them change their mind. It's very, very hard to make them understand that volatility is not risk, although volatility is simply volatility. And when we think about, for example, the general consequences of measuring these, the goodness to just give it a term, of these systems, of how investable they are. You can go in and try to say, I want this system because it tests the best. Well, guess what? One of the things we've learned over the years, that the best performance systems historically are not necessarily the best performance systems going forward. The system with the worst drawdown is not necessarily the system with the worst drawdown going forward. So if you read too much into the computer, if you read too much into the math, you are able to convince yourself that what you're doing is absolutely correct, but it may be elegant and it may be correct mathematically, but certainly it's not practical.
Look, that gets back to the very beginning of when one is devising a system. I mean, it's not, as you point out right there, it's not about just attempting to find, it makes sense to know why an edge might exist. It makes sense to know that there's probably a direct connection to what Daniel Kahneman was figuring out to win the Nobel Prize and to why you make money. There is a connection. It's about finding examples of human behavior that you can that don't go the expected way, where there's some profit left there that other people are not thinking about. And there's a logic behind all of it, for sure. But I think the tricky part is to break it down. I think about that. There's that video that Ray Dalio has with the machine. It's kind of like a cartoon. And I keep waiting. What are the traders in the alternative space going to take some of these complicated, statistically driven ideas and issues and concepts and give a nice cartoon to the world so they can understand some of these issues? It gets complicated.
Oh, absolutely. Absolutely. I'll share with you this other idea that when you are building these systems, you start to evaluate all these systems, and you have to ask yourself, well, first of all, how am I evaluating them? If you make the same mistake as everybody else by saying, I'm going to use the Sharpe ratio, okay, but you must know its limitations. So if you know what you don't know, or you know the limitations of your tools, you will make a better product than blindly believing, no, this is what we want to do, and this is what it is. And just simply, it's sort of keeping the blind faith that, the math is explaining everything.
I think next time we chat, I'm going to have to get like a list of issues, because I think I could turn you on for the next 3 or 4 hours. And I know you probably would get mad at the end of 3 or 4 hours, but then you'd be like, how did that happen? I didn't want to talk to him for 3 or 4 hours. Dang it. Hey, listen, where can we send people, Francisco? Where can we send people? Where's the best place for them to find out more information about Rabar? If people want to possibly look at the firm, where's the best place they can go?
Right. Well, the best place, we don't have a website. So the best thing to do is to Google Rabar Market Research. They would find our phone number, and simply if they have any questions about investing with us or what we do, we would be more than happy to entertain a phone call and talk them through what we do and how we do it, or to show them our technology and expertise. And hopefully we'll have a new client. But that's probably the best way of getting a hold of us.
I like the old school website. Yeah, we're not going that direction.
No, don't get me wrong. Don't get me wrong. I fully appreciate the what a website does. Simply for us, the number of investors we got is small. So what we hope is to be engaging, and I think there's nothing more engaging, as probably a phone call. So rather than having someone kind of casually browsing around, not to be shy and give us a call.
Okay, sounds good, sir. I appreciate you coming on again. I think you helped, and I told this to Mike Dever. I think some of the guys that came on early in my show helped to lay the foundation for me to ask the next person and the next person and the next person. So thank you for coming on all those years ago, and thanks for coming on today.
Well, this is a pleasure. It's nice to know that you're doing well, and it's great to hear that I done at least a good job 3 years ago and was able to be re-invited.
I think you will definitely inspire people to the complexity that exists under the surface. I think they can see that you are thinking about it nonstop.
There's no question. That's what I do.
Yep. Take care, sir.
Thank you so much. Bye-bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.